How much do you need invested to retire off dividends? When it comes to investing money, it's important to consider your goals and what you hope to achieve. For some, the aim may be to have a small stream of passive income as a safety net in case of jobless. Others, like myself, aspire to replace their full-time income with dividends. In this video, I'll be addressing the latter category and providing insights to answer the following question. Ladies and gentlemen, gather around and prepare to embark on an unforgettable journey into the exhilarating world of stocks and financial wizardry. Welcome to Stock Marketpedia, where the stock market meets showtime. Let's kickstart this electrifying adventure together and redefine what it means to be the stock market superstar. So without further ado, hit that play button, fasten your seatbelts, and let the financial extravaganza begin. Get ready for a wild ride because Stock Marketpedia is here to rock your world. Dividend investing strategy. When it comes to investing for dividend income, there are different approaches you can take. Some investors chase high yields by targeting risky companies, while others prefer a safer route by choosing lower yield, low-risk companies. Personally, I prefer a balanced strategy that falls somewhere in between. The companies I find appealing are those that offer a decent dividend payout while also reinvesting a portion of their earnings back into the business. I believe it's risky when a company pays out all of its earnings as dividends because it raises questions about their ability to sustain and grow the business over the long term. I aim to invest in businesses that can stand the test of time. Take Warren Buffett's investment in Coca-Cola as an example. Buffett began purchasing shares in Coca-Cola in 1988. This company had a solid business model and enjoyed strong customer loyalty. Buffett believed in its potential and made a significant investment. By 1989, he had acquired 23.35 million shares worth $1.8 billion. Over the years, he has profited immensely from both share price increases, totaling $19.4 billion, and dividend payments amounting to $7 billion. This example demonstrates the power of finding companies that strike a balance between paying dividends and reinvesting in their growth. By reinvesting in the business, companies can fuel expansion and drive long-term value for shareholders. Returning to our investment strategy, my preference lies with companies that offer a reasonable dividend yield and actively reinvest in their business. This approach allows me to benefit from both current income and potential future growth. By selecting companies with a solid track record and a strong business model, we increase the likelihood of finding investments that can generate sustainable dividends and potentially deliver long-term value. It's important to note that investment decisions should consider individual risk tolerance and other factors. Diversification across various sectors and diligent research are key to building a well-rounded portfolio. By striking a balance between dividend payments and reinvestment, we position ourselves to potentially benefit from both income and capital appreciation. Dividends ETFs. To determine what we consider a favorable dividend yield, let's look at some popular dividend ETFs in the US. One example is the S&P Dividend ETF, which tracks the S&P 1500 Composite Index and includes companies that have consistently increased dividends for at least 20 years. Currently, it offers a yield of 2.92%. Another significant ETF is the Vanguard Dividend Appreciation ETF, which follows the Nasdaq US Dividend Achievers Index and provides a yield of 2%. Lastly, we have the Schwab US Dividend Equity ETF, which focuses on higher-paying dividend stocks and offers a yield of 3.6%. If we average the yields of these ETFs, we get around 2.84%. However, to be cautious, let's round it up to 2.9%. It's important to note that with smart investment choices, we can potentially achieve a higher yield than the average. But for the purpose of being conservative, let's assume we are average investors and aim for a long-term dividend yield around the average. By considering these dividend ETFs and aiming for a yield in the range of 2.9%, we set a realistic target for our investment strategy. It's essential to evaluate individual risk tolerance, conduct thorough research, and diversify our portfolio across different dividend-paying companies. This approach allows us to potentially earn a steady income from dividends while balancing our overall investment performance. How much do we need? To calculate the total amount we need to invest for our dividends to fully replace our income, let's recall that we determined the average person lives off of around $30,000 per year. We aim for a dividend yield of 2.9%. To find the required investment amount, we can use a simple algebraic equation. By dividing $30,000 by 2.9%, we arrive at a figure of $1,034,500. This means we need a little over $1 million saved up and invested to retire solely on our dividends. Now let's address a couple of points related to this figure. Some people may think it's unrealistic to save over $1 million, but that notion is simply untrue. It requires consistent savings and smart investment strategies over time. Additionally, there may be individuals who aspire to live off more than $30,000 per year, and that's a valid point. In such cases, the required investment amount would increase proportionally. It's important to note that these calculations serve as a guideline and can be adjusted based on personal circumstances and financial goals. Everyone's situation is unique, and it's crucial to assess individual income needs, risk tolerance, and time horizons. The key is to develop a disciplined saving and investing approach that aligns with their desired lifestyle and long-term financial objectives. Allow me to address some common misconceptions that I often come across. Now, I'll never be able to save up to $1 million. That's way too much money. There's a group of people who look at a daunting mountain and think it's impossible to climb. In reality, they may just not want to put in the effort or time required. These individuals fail to grasp the concept of compound interest. With proper investments and allotting time for growth, saving $1 million is an achievable feat for anyone in a developed country. If you give yourself 40 years, you only need to save $179 per month to reach that goal. In 30 years, it's $481 per month. In 20 years, it's $1,382, and in 10 years, it's almost $5,000 per month. Compound interest does the heavy lifting if given enough time. The key is to start as early as possible and teach these concepts to your children. Imagine if they could retire on dividends at a young age. Even if you don't reach the $1 million mark, let's say you only accumulate $500,000. Would you complain when half of your expenses can be covered by dividends, requiring no additional work? It's wise to have the goal of retiring on dividends, and if you fall short, you'll still be in a strong financial position. Now let's address those who say, I want more than $30,000 per year to live off. It's a valid point, and the answer is simple. You'll need to save more. If you want $60,000 per year, you'll need to double the amount required for $30,000, totaling about $2,069,000 in investments. For $90,000 per year, you'd need approximately $3,100,000. It's basic math. Your desired expenses determine the total amount you need to invest. Remember, these figures serve as a generic guide. Each person's situation is unique, and factors like income, expenses, and risk tolerance must be considered. The power of compound interest combined with disciplined savings and smart investments can help you achieve your financial goals. It's crucial to start early, educate yourself and your loved ones, and make consistent efforts to secure your financial future. Process for developing a robust dividend portfolio. ETFs are an excellent starting point for those unfamiliar with them. ETFs are like bundles of stocks that can be purchased as a single package. For example, if you buy the S&P Dividend ETF or SDY, you'll own a portion of various high-quality companies that pay dividends from the S&P 1500 index. The yield on this ETF is 2.9%. However, some of you may prefer to choose your own dividend stocks and build a personalized portfolio. If you go down this path, it's crucial to have a strong understanding of investing before picking individual stocks. Just like in poker, you don't want to play without knowing the rules, or you'll end up losing. So before venturing into individual stock selection, educate yourself on the basics of investing. Once you develop a solid foundation and feel confident, it's time to begin. Consider starting with stocks similar to those favored with Warren Buffett, such as Coca-Cola. Coca-Cola has a long history of paying dividends and operates with a strong business model. Another option could be Johnson & Johnson, a well-diversified company with multiple revenue streams and a reputable track record. As you gain experience and confidence, expand your portfolio and explore additional investment opportunities. However, remember that patience is essential. Give your investments time to grow. Continuously add to your portfolio and focus on long-term growth. Over time, you'll look back and realize you own a collection of exceptional stocks, and with luck, these dividends can potentially pave the way for your retirement. It's important to know that investing in individual stocks carries risks, and thorough research is vital. Diversification, understanding company fundamentals, and staying updated on market trends are critical aspects of successful investing. By continuously learning and making informed decisions, you can work towards building a robust and rewarding investment portfolio. When it comes to dividend investing, it's important to strike a balance between companies that pay decent dividends and reinvest in their growth. This approach offers both current income and potential future growth. Starting with dividend ETFs or well-established stocks can be a good strategy, but thorough research and understanding of investing are necessary. By giving investments time to grow and consistently adding to the portfolio, we can aim for a strong dividend income. That's a wrap for today's video, but the excitement doesn't stop here. Get ready for more mind-blowing content coming your way. We'll be pumping out videos 3 to 5 times per week, so buckle up for an exhilarating ride. Drop your comments below with your topic requests because we want to hear from you. And don't forget to smash that like button, subscribe, and hit that notification bell to stay in the loop. Stay tuned for the next thrilling episode on Stock Marketpedia, where we make stocks sizzle.